Well, it is good to be back after a couple of weeks of being off, with enjoying some family, enjoying the Thanksgiving week. I hope everyone had a blessed week as well. Let's dive back into doing some mortgage business, shall we? We've seen really nice improvement in interest rates, y'all. We are sitting today in the Mortgage News Daily Tracking. I'm just going to dive right into the numbers. 30-year fixed rate average nationally, 6.68%. Yesterday, 1 week ago, we were at 6.88%, y'all. So we're down a quarter in a week. We are down almost a full half point in the last 30 days. We were at 7.13 30 days ago, y'all. So that is a nice reduction in interest rates that we've seen in the last 30 days. The predictions are that the Fed is going to move at their next meeting. We're going to look at that here in a minute. That has not always been the prediction, y'all, especially over the last 30 days. There was a lot of momentum predicting that the Fed may hold steady at their 12/18 meeting upcoming. That has changed course now, and we're going to look at what the markets are expecting now. Of course, the big mover this morning was the Bureau of Labor Statistics report on jobs. Came in stronger than expected, y'all. When we saw the headline number, I thought interest rates were going to be in for a rough ride today. But as is often the case, the internals of that report told a different story. Specifically, well, let's look at the headline number first. 227,000 new jobs, 200,000 jobs expected, 27,000 jobs more than we had anticipated. Should have hurt interest rates on just that headline number. It didn't, because y'all, if you remember the report last month, the first Friday in November, we got the jobs number for October, which came in positive 12,000 jobs, a huge miss on the report, over 100,000 lower than expected, y'all. We expected huge revisions to that report. In this report, we didn't get them. That number was only revised up to 36,000 new jobs for October, and that was much weaker, y'all. And when you look at the 60-day average over that period, much weaker than expected. That's the reason we're seeing a nice benefit in interest rates, because of course that gives the market the impression the Fed may be more aggressive in lowering. And in fact, if you look at the unemployment rate over the last 2 years, y'all, it's been steadily increasing. In fact, you go back 20 months to March of 2023, the unemployment rate hit a low of 3.2%. It's now 4.2%. So, and these trend lines are not easily remedied, y'all. So we are seeing continued weakness in the jobs number as that unemployment rate has crept higher and higher. That is giving the markets the inclination to believe that the Fed is going to be on a fairly lengthy cutting trend, which would be welcome news for interest rates. When you look at where we were 30 days ago, y'all, I like to do some practical numbers for people. If you had locked a loan 30 days ago, you would have bought a $400,000 mortgage at $2,696 a month. That's at that 7.13% amount or interest rate. Today at 6.68, it's $120 cheaper. Another way to look at that is you increase that $400,000 loan to $419,000 for the same payment. So we've increased $20,000 in purchasing power in just the last 30 days with the market move that we've seen in interest rates, and that's welcomed. What does that mean for what the Fed's going to do at their upcoming meeting on December 18th? Well, yesterday, y'all, the CME FedWatch tool had a 71% likelihood that the Fed would move a quarter of a point. That is now an 85% likelihood a day later, based on this morning's jobs numbers. Y'all, a week ago, that was a 66% chance. So we've seen a significant increase. Y'all, that's about a 40% increase in the number of investors that are anticipating the Fed to move a quarter at their next meeting, based on the weakness of the jobs report internals that we got this morning. So it's welcome news, y'all. We may be starting off the year in the mid-sixes as a national average, which would be a great way to start. And with the anticipation that we may see continued declines, I think we're going to have a very busy year with regard to refinancing a lot of these 7% mortgages that we've written this year, but also kicking off into the spring with a really nice buying season, as we might be knocking on the door of the fives, y'all. Let's talk about that just for a second. I think the market, as far as fence sitters are concerned, I think those folks are wholesale back in the marketplace as soon as we get a national average rate that starts hinting at that 5% mark. I think we're going to be within a half point or so of that happening as we go into the new year. Let's see if that holds true. And if it does, I think we're going to unlock a lot of trapped demand from people that have been sitting on the market for the last 30 months or so of this really challenging cycle. In any event, I hope this is good news for everyone. Hope everyone is staying blessed and safe as we go into this holiday season. Look forward to much more to follow in the new year. And of course, we're going to finish out the rest of this year with some updated reports as well. Stay blessed, stay safe. We will talk to you next week.